For the past 20 years, the British have been taught an almost unbreakable belief. House prices only go up. Real estate is the safest investment. It's a retirement plan. It is a legacy for the children. But 2026 could be the year that trust collapses. More than 2 million mortgages in the UK will reset interest rates in the 2025 to 2026 period. For many households, that means paying an additional £800 to £1,200 each month. Not for a few months, but for many years. Interest rates have peaked, buyers are fleeing, and the sharks of investment are quietly withdrawing capital from the market through the back door. And when financial pressure peaks, the market doesn't just make a slight adjustment. Housing prices could plummet when affordability hits its limit and cash flow disappears. This may not just be a correction. This could be the biggest shock to the UK housing market since 2008. In this video, we will list 10 cities in England where house prices are at the highest risk of crashing in 2026, those that are standing closest to the eye of the storm in the new real estate cycle. Is your city on this death list? Let's decode the first name where the real collapse was ignited. London used to be the center of the real estate universe, a safe haven anchor. But now look, it resembles a gigantic sandcastle proudly standing before the tsunami of interest rates. The disaster begins with the shock known as the mortgage reset in the period of 2025 to 2026. It is estimated that around 1.8 to 2 million mortgages across England will mature during this period, with London being the most sensitive area due to its high price levels. When refinancing at the new interest rate, many households may have to pay an additional £800 to £1,000 per month. This is no longer a dry number on a spreadsheet. It is the moment when meals, bills, and sleep start to be bargained over. The more frightening issue is many people have no backing out option left. According to analysis from nationwide experts, about 43% of mortgages issued in 2022 have fallen into negative equity or are nearing that threshold. The house, once a source of pride, has now become a prison for assets. You can't sell because you would incur a loss, but you also can't keep it because you don't have enough money to pay off the debt. Not to mention, data from Rightmove reveals a chilling secret that 147,000 property listings in London have been quietly removed because they couldn't sell after more than 300 days. This number is greater than the entire housing stock of Birmingham combined. So what about international capital? The lifeblood of this market? They are fleeing. Chinese capital has dropped by 94%, and the PIF sold off £8 billion with a 40% loss. Blood is flowing out of London's body, and no bandage is strong enough to stop it. The consequence hits daily life directly with the state of being asset-rich, cash-poor. It's like owning a Bentley but having to think about the cost of gas. A retiree might own a house worth millions but not have enough money to pay the heating bills in winter. This system is truly paradoxical. It turns paper-rich individuals into actual impoverished ones. The story of London is no longer about population or housing shortages. The core issue does not lie in the number of people living in London, but in real purchasing power and access to credit. When interest rates are higher, when credit is tighter, and when incomes don't keep up with the cost of living, affordability becomes an invisible glass ceiling. Perhaps the capital is becoming an expensive museum rather than a place to live. So how many households can withstand 3 to 5 years of continuous financial pressure? Is this just a healthy rebalancing phase, or the beginning of a longer cycle like the early 1990s, but this time without a big bang? Just a slow erosion. If you are living in London or your children are trying to hold on here, what do you see from the reality around you? Please share your perspective. And if you want us to continue delving into cities that seem safe, please subscribe to the channel. Because if London, the symbol of England's wealth, is still wavering, can Oxford truly stand firm? Leaving London, we stop at Oxford, a symbol of intellect. The ancient stone walls, the century-old libraries, the sharpest minds in England. But there is a cruel irony. Knowledge here has global value. Yet those who create that knowledge struggle to afford a roof over their heads in their own city. The issue does not lie in the beauty of Oxford. The problem lies in the gap between house prices and actual income. The ratio of house prices to income here has far exceeded the level considered sustainable for many years. The average deposit can be equivalent to a decade of savings for a middle-class family. That means even if you have a stable job, a degree, and a social position, the door to entering the market is still almost closed. Oxford seems to be falling into a paralysis. Nationwide, only about 58% of listings actually complete a transaction. In expensive markets like Oxford, this rate may be even lower. Houses are still on the market, buyers are still looking, but the transaction did not take place. Silent crash is not a price drop. It is when no one has the strength to buy at the current price level. Meanwhile, the buyer pool is shrinking. Heirs of the estate, the international wealthy. A very small group can pay in cash or borrow at low rates, and the majority of local workers. They stand outside looking in like tourists in a museum they once called home. The consequences do not stop at each individual house. When most of the income is absorbed by housing costs, purchasing power for the local economy weakens. Small shops are under pressure. Independent coffee shops and bookshops. The soul of Oxford are gradually struggling in an environment where money is only enough to pay mortgages and bills. The city trains some of the brightest minds in the world, but cannot keep them because of housing prices. We are investing in intellect only to let that intellect move elsewhere due to the cost of living. Oxford is facing a silent brain drain. The younger generation, the future of the city, is leaving to seek stability in the north where they can breathe. Can a city be sustainable if the people working there cannot afford to live there? Oxford is undergoing a necessary rebalancing phase. Or is this just the beginning of a deeper adjustment where prices must align more closely with real incomes? If you have children or grandchildren studying or working in Oxford, do they see opportunities there or just a door slightly ajar? Do you think the market should adjust by price, by income, or by another policy? Please leave your opinion. Personal stories often speak more than charts. And if you want us to continue dissecting those fortresses that seem impregnable, please subscribe to the channel, because if Oxford, the city of knowledge, is hitting the ceiling of affordability, then Cambridge, where housing prices are driven up by technology and venture capital, can it hold its ground? If London is built with bricks and stones, then Cambridge is built with ideas. But ideas don't pay the mortgage. For over a decade, Cambridge has lived in the glow of Silicon Fen. Startups sprouted amidst the ancient meadows. Venture capital is pouring in. Young engineers with stock options suddenly become potential homebuyers after a successful funding round. House prices don't rise because professors' salaries increase. House prices are rising due to cheap money and high expectations. That's the crux of the matter. Cambridge is not valued based on local income. It is valued based on the belief that technology will continue to grow indefinitely, that capital will always be available, and that an IPO is just a matter of time. But when interest rates rise, the flow of VC capital slows down. When the capital slows down, stock options are no longer as plentiful as before. And when stocks no longer generate down payments easily, the demand for housing also quietly shrinks. According to recent data, Cambridge house prices have decreased by about 3% in real value when adjusted for inflation. It sounds small, but in a market dependent on leverage and expectations, 3% could be the first crack in the glass. The high-end apartments near the train station, once marketed as the innovation hub of Europe, are starting to have more rental signs than for sale. Rental yields in many cases are no longer sufficient to cover new loan interest. When the financial equation no longer looks good, investors won't stay just out of love for science. The problem with Cambridge is not a lack of smart people. The problem is the lack of cheap money. Capital intensity decreases. The amount of money chasing each buyer is less. When the money is withdrawn, prices must self-adjust, not with a dramatic crash, but by a slowdown. Slow liquidity. The selling time is prolonged. Buyers are hesitant. The city that talks the most about the long-term future is being shaken by short-term interest rate cycles. For many years, locals have seen their city gradually becoming speculative. Land prices are rising faster than wages. Young people born here have to move further away each year to find an affordable house. Is this the necessary rebalancing, or the beginning of a longer adjustment cycle as confidence in tech growth is tested? If you work in the tech industry or have children in this field, have you noticed a change in how they view buying a house? Do they still see real estate as the next natural step of success? Please share your thoughts and hit the subscribe button. Because after the tech bubble of Cambridge, we will look at another bubble, the lifestyle bubble in Bath, where the post-COVID dream is gradually fading. Bath was once sold as a dream. The honey-colored Georgian houses, morning coffee overlooking the hillside, a slow but quality lifestyle. During the pandemic, when London became suffocating, Bath suddenly became the perfect refuge. People left the capital taking money with them, taking remote jobs with them, and taking with them the belief that this new lifestyle would last forever. And house prices rose with that belief. But the market doesn't operate on emotions for too long. When the office reopened, when the company required more presence, the equation began to change. Living in Bath but working in London is no longer an Instagram picture. Travel time, train and car costs, and high interest rate pressures are making the premium lifestyle gradually less appealing. According to some reports, the number of transactions in Bath has decreased by about 28% compared to the same period last year. Not because the city has lost its beauty, but because buyers are no longer willing to pay hundreds of thousands of pounds for a sense of tranquility. Premium only exists when the cash flow is strong enough to support it. The housing structure here also contributes to the pressure. The charming old houses come with high maintenance and heating costs. In the context of rising energy prices and high interest rates, a beautiful house sometimes feels like a fur coat in the summer. Looks luxurious, but not always practical. The second home and short-term rental market is no longer as easygoing as before. The yield is not increasing fast enough to cover borrowing costs. When some homeowners start considering selling, supply increases while demand stagnates. That is the classic formula for a correction, even if it unfolds slowly. It is noteworthy that the emotions of the local people are very mixed. During the boom period, many young families were pushed out because they couldn't compete with buyers from London. Now, as the market cools down, they find themselves caught between two feelings: worried about the value of their property, but also hopeful that their children will have a chance to return. How long can a city maintain high prices solely based on lifestyle? When incomes do not increase proportionately, when credit is tightened, can the premium still exist, or will it eventually have to give way to financial reality? Please share your thoughts. Real perspectives from people living in the market are always more valuable than any report. And if you want to follow the complete picture from the glamorous south to the industrial cities of the north, subscribe to the channel and join us in the upcoming episodes. Because when we leave Bath, we will arrive in Aberdeen, where the story is no longer about lifestyle, but about dependence on a changing industry. Aberdeen was once the black gold capital of Europe. When oil and gas were thriving, salaries were high, bonuses, where large restaurants were packed on weekends, and house prices increased almost without a second thought. For a long time, real estate here reflected the belief that the energy sector would always be the driving force propelling the city forward. But the housing market does not only reflect the present, it reflects the future that people believe in. And when that confidence wavers, house prices begin to tell a different story. From the previous peak, house prices in Aberdeen have decreased by about 37%. Some apartments have decreased by 40 to 50%. Not overnight. Just year by year, the value slipped down like the tide receding. The population is declining. Central stores are closing more than opening new ones. The city isn't collapsing, but it's slowing down. The deepest impact is not in the charts. It lies with the families who are stuck. When house prices plummet, many people cannot sell to move and seek other opportunities. They stay not necessarily because they want to, but because they no longer have reasonable financial options. Children leave the city to find jobs elsewhere. The house that was once considered an inheritance is now gradually losing its value over time. When everything is favorable, people say the market reflects economic strength. When difficulties arise, the market reflects an excessive dependence on a single industry. Aberdeen shows what happens when a city places too much expectation on a single engine without having time to build another. If you live in a city that relies on a major industry, have you ever wondered what would happen if that industry slowed down? Please share your thoughts, because Aberdeen is not just the story of Scotland, it is a reminder for the whole country. And if you think Aberdeen has struggled due to a lack of demand, then Manchester tells a completely different story. There, the problem is not a lack of buyers, but building too much for too few actual residents. Looking at the Manchester skyline today, you might think you were standing in a miniature version of Dubai. Glass towers rise densely. Cranes spin like clock hands that never stop. This city is told as the great Renaissance story of the North. But there is a simple question that few dare to ask out loud: who are those apartments really for? For many years, Manchester has become a destination for investors. Central apartments, especially in Salford, are being sold as a ticket to the future. According to some estimates, about 1/3 of the new apartments here belong to investors rather than actual residents. When money is cheap and yields are attractive, that model operates smoothly. But when interest rates rise and borrowing costs increase, yields start to shrink. Zoopla recorded city centre rental yields dropping to their lowest levels in many years. That creates a downward spiral. Investors want to exit. Young buyers want to enter the market but are stuck in illiquid shared ownership models. Supply is starting to outstrip demand. The glass towers sparkle at night, but if only a portion of the apartments inside are lit, they look more like vaults for capital than vibrant communities. We talk about urban redevelopment, but sometimes we build more for the balance sheet than for families. When buyers truly can't keep up with the prices, the market has to adjust, whether slowly or quickly. If speculative capital withdraws, does Manchester still have enough real demand to maintain the price? And if prices start to adjust, what will buyers at the peak face? And if you think overbuilding is the biggest issue, then Birmingham shows a different scenario. There are mornings in Birmingham when you drive past a new housing development and wonder why so many windows are still dark. Not because they are unfinished, but because no one lives there yet. In recent years, this city has been driven by high expectations. Infrastructure projects, growth stories, the belief that the West Midlands will become a new driving force. The developers are building vigorously, but the market doesn't always meet expectations. Currently, there are about 7,300 unsold new homes. About 41% of small contractors are said to be under cash flow pressure. Incentives of up to £50,000 have been introduced to stimulate demand. When you have to give away extra money to sell, it's usually not a sign of a hot market. What about the buyers? They observe. They wait. When they see the offers getting better, they have even more reason to delay. Investors are starting to reduce their land purchases. And when builders stop buying land, they are not necessarily being pessimistic. They are just reading the numbers before the rest of the market catches on. Birmingham does not lack houses. Birmingham lacks the belief that current prices reflect local incomes. When the average deposit remains a significant barrier and the cost of living rises faster than wages, signing a home purchase contract becomes a hesitant decision. What do you think will happen if supply continues to increase while demand remains cautious? Will the market self-correct gently, or will a clearer adjustment be needed? Let us know what you are seeing in your area. And next, we will go to Nottingham, where the pressure does not come from too much construction, but from the rental market starting to shake. There was a time in Nottingham when people jokingly said that just buying a house near the student area would give you automatic retirement income. The buy-to-let model operated smoothly for many years. Many students, stable rental demand, low interest rates, but the market won't remain stagnant for an old formula forever. Currently, the number of buy-to-let homes for sale here has increased by about 40%. Rental yields are being squeezed as borrowing costs rise, while rents cannot keep increasing at the same pace. Higher energy efficiency standards also require many landlords to invest more, while profit margins are already thin. The consequence is a widespread feeling of unease. Small landlords are considering leaving the market. Renters are concerned that supply will shrink or prices will be adjusted suddenly. A system once considered sustainable for the middle class has now become fragile. There is a bit of irony here. When buy-to-let can no longer sustain itself, the market must ask itself what it is relying on. If the buy-to-let model is no longer attractive, what will keep house prices in Nottingham? Will the adjustment be smooth or prolonged over many years? If you have ever invested or rented a house here, do you feel the change in the market atmosphere? Please share your experience, because when yields waver, pressure will gradually become apparent elsewhere. In Leicester, the issue is not about glass towers or luxury apartments. The problem is much simpler. Real incomes have not kept pace with prices that have risen over the past decade. About 40% of buyers have to rely on support from their families. The average deposit of around £27,000 has become a chasm for many young couples. As real incomes decline after inflation, the dream of homeownership hasn't shattered, but it has been pushed further away each year. The market isn't crashing dramatically, it's slowing down. Low liquidity, houses are on the market longer. Silent crash here is not a sharp price drop, but rather when transactions gradually decrease simply because there are not enough people who can afford to buy. The question in Leicester is very straightforward. What should house prices ultimately reflect, real income or borrowing capacity? And if the younger generation increasingly relies on the family bank, what does that say about the market structure? Do you see the gap between prices and wages becoming more pronounced in your area? And if Leicester is a story about income, then Coventry is a story about supply and demand clashing head-on. Imagine you build 100 brand new houses, but when buyers step into the showroom, the first question they ask is not when will they be delivered, but will the price drop further? That's Coventry right now. Supply has increased rapidly in recent years, while real purchasing power has been eroded by the cost of living and mortgage reset pressures. House prices have started to decrease in nominal terms after many years of continuous increase. The reduced signs are appearing more frequently in the windows. Not loud, but enough to shake confidence. The city is also under pressure from the transition of the automotive industry, a crucial pillar of employment. When jobs are no longer secure, people will be more cautious with a 25-year loan. That is completely understandable. Coventry is like a microcosm of the entire country. When cheap credit is no longer available, the market must learn to stand on the solid ground of real income. But will that process be smooth or fraught with difficulties? If you see more discount signs in your neighborhood, do you think it's an opportunity or a warning sign? Share your thoughts. Perhaps the most noteworthy point is not where the decline is the steepest, but that the UK market is entering a completely new era. When looking back at the 10 cities, what stands out is not which one will decline the most. What is noteworthy is that a common pattern is emerging. House prices for many years have been supported by low interest rates, easy credit, and the belief that real estate always appreciates. But 2026 seems to be questioning that. This may not be a crash as loud as 2008. No lines of people outside the bank. No more panic headlines every morning. Instead, it is a slower, deeper, and generational process. Nominal prices may not be falling sharply everywhere, but real value is being eroded. Liquidity is decreasing. Buyers are hesitant. The seller is stuck. So can the market return to a level that real incomes can support? When teachers, nurses, and young engineers can buy houses without relying on family wealth, could that be the true sign of a bottom? What do you think? Are we witnessing a healthy rebalancing after years of overheating, or is this the beginning of a longer downturn? If you live in one of the cities just analyzed, what are you seeing in real life? More discount signs, longer sales period, or is there still strong confidence in the market? Please leave your perspective below. Real-life experiences are always worth more than any chart. If you find this analysis helpful, please like it, so more people can access it. Share the video with family and friends, especially those who are considering buying or selling during this period. And if you want to continue following in-depth neutral and data-driven analyses of the UK market, subscribe to the channel so you don't miss the next episodes. Finally, an important note. The content in this video is analytical and for reference purposes only, not investment or personal financial advice. The real estate market is influenced by many factors and can change over time. Before making any financial decisions, you should consult with an expert suitable for your circumstances. The market can change, the cycle may come to an end, but true value in the end always returns to the economic foundation and the purchasing power of people. And perhaps that is the most thought-provoking story of all.